Well, a lot of times it's not the kids.
Mm-hmm.
It's their influence from spouses or other friends or things of that nature that get in the way of everything.
Yeah,
especially in that process.
Absolutely, yeah. The in-laws and everything else.
And truly, in those kinds of will wars scenarios, you know who wins?
The government.
The attorneys.
The lawyers.
Oh. Welcome to Planning Reimagined, a podcast from the planning experts at Robin Glenn and RX Investment Partners for wealthy families and successful business owners.
If you were hooked on the family drama in HBO's hit show Succession, then you saw how they constantly fought over power and money. And while most of us may not have this giant media empire to be fighting over, in real life, a lot of families have similar succession drama. But there is an important lesson to be learned from the Roy family, that not just building your wealth is important. That's just the first part of the process. But really, what are you going to do to plan and protect it for the future, to be able to safeguard it and ensure the next generation can have it there for you as well? So the Roy family teaches us an important lesson. Even though it is a primetime drama, there's something to be learned from it. Planning and meticulous planning from an estate perspective is just as important as building your wealth. So in today's episode, we're going to be talking about some really important estate planning strategies that you can utilize so that your family doesn't become a primetime drama.
In our last episode, we talked about the intersection of taxes and real estate. And if you haven't listened to it, you must go check it out because it's important information for anybody that's out there building a portfolio of real estate or building their wealth through real estate. So today we're going to talk about what comes after you build wealth. How do you protect it? And how do you ensure you can transition it successfully to future generations? So today we're joined by our guests. So we have Kris Stiegel with Robin Glenn, and we also have Mark Auten, who is an attorney specializing in estate planning and asset protection at the Smith law firm. So thank you so much, Mark, for joining us. We really appreciate it. And already in advance, thank you so much for your expertise that you're going to share with us today. So let's jump into it. A great example of preserving wealth is the Kennedy family. So through the years, they have done a wonderful job of wealth preservation. And Joe Kennedy, the patriarch of the family, foundationally set this up for them. He was a leader, if you want to call it that, when it comes to wealth preservation. It was an important thing for him. So he started setting up trust for his family. And then he instilled the importance of having that wealth preservation. So all these future generations have done the same. They've protected their assets, their wealth for their family, and they've instilled these same values. So we're not talking about a family that, had that shirt sleeves to shirt sleeves type of scenario, like so many have in so many scenarios. So we want to, what can we learn from them? How can we also preserve our wealth like the Kennedys? So Mark, why is estate planning the secret ingredient for a real estate empire that stands the test of time?
Yeah. So Celeste, in all reality, we're going to die.
Yeah.
Right?
No, because our people are immortal, right, Kris?
Yeah. Oh man, we're just going straight to death. All right. Cool.
Jump right in. Death and taxes, those are the two things we have to deal with. And if you don't plan for them, one or both will get you. From my perspective, at least, as the attorney sitting down with clients, talking to them about pros, cons, what can we do? What should we not do? At the end of the day, to me, it comes down to preserving assets, kind of creating a continuity of management in terms of their real estate portfolio, if they're actively engaged in the management of it, how do we make sure it continues on beyond that? And then protection, right? Not only from creditors or other individuals trying to come after them and their assets, but then disputes between parties. I've seen many cases in probate court where families end up getting into some disagreements.
Disagreements.
Right? And
all of our families get along also. Nobody dies and everybody gets along. So this is foreign.
Right?
Yeah.
It's like grief and greed, the two things that we're going to experience when we die. And so, or our family will. And so, to me, it's if we have it in writing, if something says this is the intent, these are the expectations, people can rely on that. Mm-hmm. Still doesn't solve all the problems. If your family is contentious, that's what's going to happen. And the lawyers will win. Well, and at that point, it's kind of like, we'll remove the family from the circumstances altogether. And we can dive into that through the portion of this podcast and as we have our conversation today, but definitely preservation of the assets, continuity of management, and protection of their assets and what they've built are kind of where I approach my clients.
Yeah, so and I think what families or sometimes patriarchs don't think about is that through the years there's so much other people that are going to join the family, and they each have their own thoughts about how things should be handled. We worked with a family who it's two sisters. One of them married a husband that is very silent. He will literally be in board meetings and he will sit across the room in a corner. But the other husband is very involved and has sometimes has conflicts with the other sister because of his approach to things. But really, the two sisters are the wealth holders, right? And their parents, who are deceased now, I don't think they had the foresight to see some of that, because in some of their planning, his comments, his interjection hasn't always been the most positive for their planning. So I think it's also keeping in mind that through the years, it's not just going to be the voices of your own children or your grandchildren that maybe you did raise in a way to, have that emphasis on doing things the way that your family likes to do them. There's going to be other people that come along and maybe don't have the same opinion, right? Or there's greed. Yes. There's also greed. So there's
100%. Yeah, I've seen one with, it's not a necessarily real estate focus, but a nonprofit organization that was, a private foundation that was very millions and millions of dollars in it. Parents passed away, passed down to the next generation, and the kids of that generation are saying, well, we don't all like each other, so now we're going to break it all up, and they're going to go run away and give grants out to whomever they want.
Right.
So it's not, and so when you think about like the Ford Foundation or some of those other larger private foundations, that legacy is now being destroyed because proper planning wasn't instilled from the beginning. That proper expectation, the legal protections weren't built into the plan early. So there were ways or loopholes, as we like to put it, out of what the intent of the founders was.
Yeah, absolutely. And when we think of business owners too, and I'm sure, Kris, you have thoughts about this part too, is, they do so much other planning. So there's buy-sell agreements and there's so many other corporate structures that are put into place. But when it comes to their personal planning, they need to somewhat approach it like a business as well to ensure that it's done properly. Because if not, it's the same legal issues that they would have from a business perspective. And Kris, I'm sure you've seen some of that too.
Yeah, no, for sure. And it's one of the struggles that I think that I see whenever I'm working with a family is trying to balance out sort of the math behind why something might make sense, but then the sort of the psychology in the family and what might actually make sense for them emotionally, right? And so there's this weird balance that can happen whenever you're doing that sort of estate tax or that estate analysis about how do you want assets to move on, what do you want to try to retain in the estate now, all those types of things. It's not as black and white as one would think.
Yeah, unfortunately, there's a lot of gray.
Yeah, you can't just rely on that TikTok or that reel to tell you how to put up, how to properly structure your business with this trust and the like. I mean,
right.
Sometimes those are my favorite clients to talk to, though. But.
Or I can't manifest it to happening because I get all these manifestation advertisements on Instagram. I don't know what I clicked on, but I get them all the time. Another thing that we've come across with clients is that they essentially fall into estate planning paralysis, right? They just feel like it's too daunting. There's too much to do. So they end up doing nothing, which is very bad, right, for in a lot of situations. So in your practice, where do you generally advise clients to start? Just a place they can start that doesn't seem too overwhelming when it comes to estate planning.
To be honest, it just takes a phone call, right? I mean, so many people have that paralysis because they think it's going to be daunting. I'm going to have to fill out all this paperwork. I'm going to have to do all these things. And you will, but if you have the right advisors around you, it's really easy, right? Because other people are helping you either get documentations in place like I would do, or they're helping fund the different aspects of the planning that we're doing. But at a bare minimum, a lot of times from most estate planning attorneys' perspectives, what we need from our clients is stuff they already have. Names, addresses, phone numbers, basic information. And then we kind of do a data collection through the initial phone call to learn more about them, what's the right strategy. And then we talk about documentation. What is a trust, a will, financial power of attorney, medical power of attorney, directives, guardians. And, the funniest conversation I have with clients who have when I bring up guardianship, they go, oh, I don't have minor kids. I go, well, every now and then we go back to our childlike mentality, and so we need a guardian for ourselves.
Absolutely.
We still have that conversation. And again, having the documentation in place, to me, is step one.
Right.
Step two is, and in most instances, when we're setting up like a family revocable trust and the like, it's great, you have your trust, but have you funded the trust? That, to me, is the most important part, because the main purpose of a trust is to avoid probate. people sit back and go, well, if I have a will, I don't go through probate, and that's not true. A will go through probate. A trust avoids probate. But at the end of the day, they pretty much communicate the same thing. Mm-hmm. This is where my assets go, and this is who's in control.
Yep.
Right? And so figuring out what level of planning the client needs and what their propensities are in terms of protections for their family kind of dictate the route that's most appropriate for them. But it's not a cookie cutter approach. Everyone's so different, as y'all probably are aware too, in terms of y'all's business.
Absolutely. Every single client, we would think we're in life insurance space. It's just life insurance, right, Kris? That's all that it is. But every situation is so different. So I love it when I get the call from a client that's like, I need $5 million of life insurance. I'm like, fantastic. That's great. But I have no idea why you want it. And if we can just talk about objectives. So I think that's part of what you're sharing as well. It's like, what are the objectives? Of course, you need the high level, just fact finder information, but it comes down to objectives, and then you can help them determine, well, this is the route. Maybe it's a revocable trust, maybe it's an irrevocable trust, or another planning vehicle that you can help them put in line. I think that's an important thing for our audience to take away, is that they don't have to have the answers. They don't have to know what to do. They just have to find the right expert. Another thing, and not just to plug you today, but another thing that I found to be so important is have the right advisor. We work with so many clients that have grown too fast, or maybe they've had their same multifaceted, I will call them, attorney that has helped them for so many years. But that attorney might be more business focused, or they, may have a different expertise. And estate planning is very much a beast of its own. So finding an advisor that has, like yourself, that specialization in the estate planning space is important. And yes, it might be another advisor and another bill. And I know our clients are sensitive to that. But at the end of the day, it's going to save them a lot more money to have that one advisor that knows what they're doing. I had a situation, it's been years now, where a client had an attorney he had worked with for many, many years. They were out in Amarillo, and the attorney was, once again, multifaceted. And so he did everything for him. Well, when this client passed away, they realized their estate really wasn't in order because there was a lot of gaps in the planning because the attorney just didn't have the expertise. But also maybe his ego got in the way of saying you really need to go consult with somebody that, has expertise in this space. So I think it's important to know, whatever you're planning for, ensure that you're working with somebody who's in that lane and truly understands it. Because there's so many vehicles. I mean, we joke that in the estate planning space, it's like the alphabet soup of trust, right? There's CRATs and GRATs and SLATs and some others that may not sound so appropriate.
I always liken this to like having a general practitioner doctor. And like, if that's where you're going to go year in, year out, just to kind of have your checkup and make sure everything is kind of normal and okay. But if you need surgery, you're not going to rely on your general practitioner to put you under a knife. Like, that's not a thing. You're going to go see a specialist. It's going to have a much better outcome.
And that's a great example. Yeah, estate planning is surgery. I mean, it really is. Because you're delving deep into something very different.
Even though some people try to portray that it's not, it really is, especially for higher net worth, high income earners. I mean, more money, more problems, right? And so, but having, resources and advisors that can give you practical, real advice, right? That to me is the biggest difference, right? That's why in my practice, I love the fact that I do about 50% of work in corporate space, 50% work in estate planning, right? So then I'm blending the two. So that's perfect for a business owner that may need someone to look at both angles and be able to talk to other counsel, tax advisors, insurance professionals, other advisors of that nature to have the holistic approach with them instead of just being narrow focused on, I'm just your corporate counsel.
Right.
And so,
right, absolutely.
And I think that, and you said something a second ago as well that I want to touch on, I think is wildly important, because like you can come across attorneys and accountants, et cetera, that have a lot of expertise in this field, but to be able to educate people in a way that they understand is hugely important, because so many people, like you said, Celeste, we have a laundry list of different acronyms that we can throw out there, and it can get confusing very quickly. So the education is key. But Mark, to a point you made a minute ago, like execution is really key. And so, and I think you hit the nail on the head a second ago when you said that that's something that your practice does as well. It's something that we have a lot of focus on too. It's like, execution. It's not okay just to set up the trust and then that's kind of it. You have to fund it, and somebody's got to follow with that, and somebody's got to make sure that actually happens. Otherwise, the planning was sort of for naught. So I think that execution is really key as well.
And having somebody that can help you with the follow through and it keeps you accountable for it, right? Because, I mean, I can tell you in my personal life, there's a lot of things I need to do, but if somebody's not holding me accountable, it's going to fall through the cracks because I have 100 million other things happening at the same time.
100%. I pay for a gym membership that I don't use, but I will one day. I will. I'll get there.
So for a while, funny story, I had like 3 gym memberships because it was one of those where you had to go and like personally walk in and cancel, which I hate.
Oh, gosh.
And I just hate that. I'm like, why can't I send you an email? I don't want to go anymore. So I think for like 6 months, I had 3 different ones at one point in time. And I was like, fine, I'm just going to go and do this.
You got to spend a day doing it. You might as well get the workout in when you're there, too.
I know, right? I'm like, I'm giving you my money for free.
It's so funny you bring that up, like the gym membership. When I moved away from Austin, I had to deal with that because it was like the last thing I thought about. I'm like, oh yeah, I need to cancel my gym membership. And I was already in the car, and I was like, I had plenty of time while I was driving. It's like, oh, I'll just call them while I'm driving. And they tell me, no, you have to come in person and do it. I'm like, no. No, it doesn't. It was a big argument. That's anyway.
So ridiculous. Whole other conversation. Well, James, why do you do this to us?
Yeah. I'm like, what year is this? This is ridiculous. Anyway.
Yeah. So we've talked about some of that foundational planning, right? So you having your wills, some of those trusts that are kind of, I would say, table stakes when it comes to estate planning. Now, we can talk a little bit more of multi-generational planning. So one of the things we hear of are like generation skipping trust, other things like that. Because part of what we really want to touch on today is, like I mentioned before, you build the wealth and it's great, but at some point you have to transition it because we're going to die. And so you want to make sure that you do it in an efficient way. Some of our clients are happy to transition it to a child. Some of them want to make sure it only goes to grandchildren or ensure there's some of it. Some of it want it to go to a nonprofit. So what are some of the most common or what are some of the strategies you suggest from a multi-generational planning?
Definitely. And I'll start with, before you even get to an irrevocable trust, right? We start with the foundation of the revocable trust. But even within that, it's really important to talk with attorneys, whether it's me or any other estate attorney, of how do they approach the insides, the guts of the family revocable trust? Because there's multiple different ways to craft it internally. And especially if you have a husband and wife couple, if one passes away, does it go all outright to the surviving spouse? Or do we set up a type of marital bypass structure, which back in the day was an AB structure, where the deceased spouse's 50% of everything becomes creditor protected? It becomes, insulated from future spouses. I joke with my wife and I joke with clients about this all the time, where it's like, if my wife passes, I have a 3-year-old and a 1-year-old. If my wife passes, there's no way I'm raising those kids without a motherly figure, and vice versa. Right. I'd really hope that my wife would remarry, get a solid fatherly figure in there for those kids, right? But I don't want that new spouse benefiting from what I leave behind. And so this structure internally, this marital bypass structure where we can kind of bifurcate the trust when one passes away, is very advantageous for that. But if you tell me you don't have significant net worth, I'm talking you don't have some life insurance policies that will become subject to creditors after they're paid out and certain things of that nature, then it's not the right fit. But for a lot of clients that have businesses, have key man policies, buy-sell agreement, portions that are funded with life insurance, it's instrumental to have this kind of structure to help that protection going forward in life. And so once that kind of piece, that foundation is put together, we now have everything we need really for that next level of advanced planning, where we're talking multi-generational planning. And to me, when you start talking multi-generational planning, you're also raising issues of generation skipping, which is what you talked about. And generation skipping is typically defined as jumping from one generation to the next. But it can also pass down through the different generations. And as you're doing certain irrevocable trust planning, right? And this is a common deal. We set up a certain kind of trust. We call it an inheritors trust. It's a 678 trust. Beat it for all of those legal minds out there, people that know it. But what it is effectively, a third party sets up a trust for your benefit. You're the trustee in control. You're the beneficiary who benefits. But a third party, say a parent, is the grantor that gifts that trust into existence with $5,000, okay? $5,000 is under the annual exemption amount. So most people will say, and even some CPAs will say, you don't need to file a gift tax return. Well, if that trust, which is likely going to now consume the $50 million you've accumulated in your lifetime, well, it needs to, because that $50 million probably won't be eaten up at the next generation. It'll be used in the next and the next and continue passing on. And if you don't elect in the gift tax return of that $5,000 gift to elect generation skipping, then you're going to be taxed at those generational skipping transfers. And so that's why it's important to ensure that the advisors are walking you through that process too. But those inheritors trust are very popular tools. Another one's called a SLAT, spousal lifetime access trust. Note the term spousal.
Yeah, key term.
Very key. So you kind of got to be married for that one.
And don't get divorced.
Didn't have a solid marriage. But you know what? Even then, we had clients that we did spousal planning, a SLAT planning for them, and they were married for another about 7-8 years. Kids graduated. They entered into retirement, effectively kind of moved back into their house together and realized, oh, wait, we have to spend this much time together? And it was all mutual, don't get me wrong. But they were like, the divorce was super easy because what was in his SLAT is his, what's in my SLAT is mine. That was that.
Right.
And so
if they can agree on it, right? Perfect.
That's the key.
Yeah.
But in a lot of those instances, like, I have someone with about $25 million and another one with about $5 million. It's inequitable there. So how do you kind of create equity and then divide it out later on? And SLATs have some complications in there for that, but those are two popular ways too.
They can be great tools. We look at a lot of SLAT structuring. Some of them are funded with life insurance because in case there's a death, it kind of offsets some of the loss there. But they also have those issues that people have to be aware of as far as, likely you should stay married. Makes it a little easier. I was just sitting it was an educational meeting. It was an estate planning council meeting where they were talking about a husband and wife that had SLATs and they had art in their SLATs. And then they got a divorce, and that was very messy and problematic because they did not want to give up access to this very, pricey art. It was near and dear to them. So all those caveats are huge to be aware of. How do you? And I'll ask the question, and then I'll tell you why I'm asking it. How do you build flexibility into some of these trusts that could be in perpetuity? Right? I know that there's been some talk about adding restrictions to how far these generation skipping trusts go. But I'll give you an example. Recently, we came across two brothers that have these trusts set up for them that say the beneficiaries of their trust can only be natural-born children. Well, great, right? If you have children. So one of them does, the other one only has stepchildren, and so his proceeds will go to his brother's children. So that's just one example. I've seen so many where the language is outdated. It just doesn't really fit reality today, right? Or it's so restrictive, like you can only get the money if you get married to a man or to a woman and you have children. If not, you get nothing. So what do you give? What kind of advice do you give, or what can be done to build some flexibility into this planning?
Definitely. I will say you always go back to what was the grantor's intent or the parent's intent. Sometimes there's no way around it. That's the way the parents see it, and that's how it is. Psst, there are loopholes. So we'll get to that in a second. But the most popular tool we talk about with clients in that regard is something called a power of appointment. And so a power of appointment, you can grant it to one of the beneficiaries that say, here's a class of individuals that you can reapportion this to. I always use that scenario as in, okay, your child has 3 kids. So you have 3 grandkids. 2 of them are phenomenal, great people. The other one, where are they? We don't know, right? They just got estranged from the family. No one talks to them. They don't want to talk to the family.
He's the artistic one.
Yeah. Sometimes. And so that the child and even the grandparents may be like, well, I don't want this inheritance that I'm passing down to go down to that child. I mean, that they don't deserve. They're not part of the family anymore. So this would allow, the power of appointment allows that beneficiary to appoint that property to the other 2. So then it would go down to the next generation 50-50 and so on and so forth down the lines. And there's some mechanisms all within these documents too to appoint, like even if I appointed it to a beneficiary, but I appointed it to a trust for that beneficiary. So there's always, like I said, one of my favorite, lawyer jokes is, why was a lawyer flipping through the Bible before he died?
I don't know. I've never heard it. Tell us. We all want to know.
He was looking for a loophole. All right. So there are always those components going through
I don't
this.
want to die.
I know. I'm all about death. But there's something in the law called decanting.
Yep.
And decanting is a very popular tool. There's certain.
If you want to explain what it is too, because people may have not heard of it.
Yeah, decanting is it's in the Texas statutes, and it allows you to, in layman's term, it allows you to take the words on the trust that are irrevocable and replace them with different words. Okay? It's a lot more complex with that. Don't do it without legal supervision, please. But it is a way to create different structures within the trust at that point, or redesign some portions, because a trust that was done in 1990s doesn't have any of the unique language that we use nowadays to create more flexibility. Yep. They were a lot more rigid. One reason was because the estate exemption amount was so much lower than now. And so we've used that in countless times to, and for the most part, if all the beneficiaries can agree, right, there's a lot of flexibility there.
Yeah, yeah, absolutely. You mentioned estate tax, and so that's a great kind of segue into kind of the next point of this conversation. We know that there's going to be a huge transition of wealth over the next 30 years, right? I think it's projected like at 36 trillion or something like that. So it's really important for those. I think it's a lot of the baby boomer generation to really look at their planning. And what do they want to do with it? We always say it's going to go to one of three places, either to your family, the IRS, or to the community if you're going to do some kind of nonprofit planning. There's really no other place it's going to go to. So it's more important than ever to be proactive about that planning, because you're going to have to transition your wealth. But with that in mind, we also know that right now estate tax exemption is really high, over $13 million per person. We expect that there's going to be some changes at the end of 2025 if nothing is done, which it seems like it is, or maybe the exemption's now going to drop to $7 million. Yep. So what are you seeing from your client's perspective, or what are you advising at this time? Because it's such an important time to take advantage of what they have access to, right?
No, it is 100%. And, beyond just estate tax planning with this, when we talk to clients about this unique planning, advanced planning, it's also creditor protection planning too, right? And so it's multifaceted, and each client kind of approaches it and has different perspectives with what they're trying to achieve there. But with that estate exemption dropping from 13.6 down to roughly 13.6 down to roughly 7, right? It brings in a whole new wave of people that may need to approach this planning, right? And so it's trying to get the news out, right? Create the headlines to let people know, hey, you may need to actually consider this. Because if you are over 7 now, when it sunsets and at the end of 25, start of 26, you're losing out on that extra, delta that you would normally get there. And so by having the conversation now, you can take advantage of the higher exemption amount, move more assets out of your estate. So, come on, you've already paid the IRS for that money, right? You don't need to pay them 40% more on those dollars over that exemption amount. And so, and there's a number of different planning tools. I always tell clients, we can get it out of your estate, or you can figure out a way to pay for it. Or a combination of both. I have a client now that we're moving a significant portion of his wealth out of his estate. But because he's only a single person, he's going to have a promissory note. Well, with that, that's now a promissory note in his name that he's owed money from this trust. Well, if he dies, that promissory note is in his estate and is taxable. Right. So with him, now we got to figure out a way to pay for it. Either we use your assets that you have, or we look at like life insurance. Like that's the conversation we're having with him, is bring life insurance back into it. You're a healthy individual, right? You don't have any, something that would automatically disqualify you. We could get you good life insurance and have that now fund your tax burden at that point, right?
Absolutely.
And if you end up paying the note off by the time you pass away, guess what? You still have the life insurance benefit that goes and passes out too. So
still liquidity.
Exactly.
I always tell clients life insurance is liquidity, so that you or your beneficiaries or your estate, they can do with it whatever they need to do at that point in time. So yeah absolutely. It's a conversation we're having a lot with clients right now. It's top of mind. People are concerned about what will happen versus waiting. It's important to at least be realistic and know it could go away. You do need to do planning. Hiding in the closet and doing nothing is not going to solve any problems either.
No, head in the sand is not the mentality.
Right, not here. Especially when we're talking
totally
millions.
Yeah, it's only like, a couple of years ago when this question would pop up about, I don't know if I'm comfortable giving away that much now or not. I used to just deploy the strategies of the one that you were just talking about, Mark, where you would just sell the assets to a trust with the idea of like, I'm just kicking the can down the road until it gets closer to 25, and maybe I'll just kind of gift it away at that point if I'm comfortable with it. Mm-hmm. And that time is gone now, right? So you don't have that same sort of wait and see how I feel later approach with 2025 looming. To your point, it's really about trying to get that information out. You've got to do planning pretty quick if gifting is going to be part of the equation, and your estate is over that exemption, right? So are you trying to get clients to act now? What would you say to families who are still kind of sort of thinking through it right now?
I'd say the sooner the better, obviously, and especially in a spousal lifetime access trust, a SLAT situation, because one of the issues with that is if you go out and create these two SLATs, because you have a husband SLAT, wife SLAT, right? Yeah. If you create them at the same time, fund them with the same thing, the IRS is going to say, no. Reciprocal trust doctrine, that all of that you just did is back into your estate. So you need 6 months at minimum, ideally 2 calendar years. So if you say, I'm going to start this planning in 2025, well, we don't really have the second calendar year to have the best protection from, say, an IRS audit on something of this nature.
Right.
And so by starting now, you could have a SLAT set up now. You could do the next one in January of 2025. You do the final gifting transactions in 2025, and you're set. I mean, granted, you always need to do a proper, third-party valuation on the assets you're gifting. That's your first line of defense if the IRS ever comes and questions it. But again, I mean, the sooner you start this process, the better. I have some that are saying, I'll wait for the election and see how the election turns out. I know.
You're giving me 2 months.
Even then, it's our Congress, it's our government. They don't necessarily act with swift speed, and so to me, it's better not to wait on that. And one of the other things that kind of going back to that last scenario where the trust purchases this interest from the individual and the individual gets a note from the trust. We've done planning in that scenario where then the person assigns or transfers or gifts that note into an ILET, which is an irrevocable life insurance trust, which now is a one-time gift and creates a stream of income that the trust can now pay to the ILET. And you don't have to keep paying gift tax returns. You can just keep paying premiums and roll in premiums over into the life insurance trust there too, which is a great strategy to help reduce legal and CPA costs and things like that from a year-to-year basis.
And for our financial advising friends that may be listening, because we talk about that strategy too, it's a way for them to not have to get rid of these assets under management, because essentially you're putting them from one bucket to the other, but they could still manage those assets for their client too.
100%.
So it's efficient for the client, it's good for the financial advisor, it's more cost efficient over time if they have the ability to make that one-time larger gift into the ILET. And obviously they're not, it's assets or money that they just don't need to have access to. But yeah, that's a great strategy, something that we talk about too. And I appreciate you talking about life insurance and bringing it up. As you know, at Rob and Glenn, that is one of our areas of expertise is curating these life insurance solutions. Our goal is always to ensure that it enhances the client's estate plan. So just earlier today, we were joking about how some of our colleagues in the industry, in the life insurance space, they feel life insurance solves all world problems. So it's that, a square peg into the round hole all the time. And we just take a much different approach to how we look at it, because we have to ensure that their planning is in place, that they have some planning done or getting it done before we can responsibly assess the risk and determine where does the life insurance fit? Where is it going to make your overall planning better? What risk is left over? So Kris, this is your area of expertise, and this is what we do day in and day out. But can you talk about, and Mark's already addressed some of it, so I appreciate that very much. But can you talk about how life insurance can play a role in estate planning, and why is it that so many of our clients use it as a financial tool?
Yeah, no, for sure. Thanks, Celeste. And thanks, Mark. I love that conversation, because I think a lot of people, whenever they think about estate planning and they think about trust and they hear the word irrevocable, it sounds very rigid and unmovable. So I appreciate, all the comments you had about SLATs and BEATITs and, how the structures can work, doing sales and how that can benefit the family, how they can still, receive income out of those types of things, actually. And the different things, again, that you can do with gifting. And so that's kind of like the backdrop to Celeste's point. What we do at Rob and Glenn is that kind of planning. So, we want to try to make sure that all the arrows in the quiver are, looked at. Does this apply? Does it not apply? How does this affect your estate? How does this affect your overall plan? Is this what you want to use? Yes, no, okay, move on. And then at some point you get to this place where you're like, well, I think that we have planned as much as we can as far as gifting and selling assets and things like that, but we still have, a liquidity issue that we need to address. And I think it goes in a couple of different directions. And I'll start with, I'll actually start with the SLAT, because I think that was a really good point that you brought up, Mark. So you set up one spousal lifetime access trust that benefits, I'll just use myself as an example. If I set one up and it benefits my wife, Kimberly, if something unfortunately happens to Kimberly, well, I don't have access to that indirect access to those, that trust anymore by way of my wife being a beneficiary of it. And the best way for me to protect myself against that type of a loss would be to have an insurance policy on Kimberly, such that if she passes away before me, I now have, a life insurance policy that offsets the fact that my kids now are the beneficiaries of that trust and no longer my wife. So that's just sort of one play, but the other things to think about, estate taxes. I don't think there's a better tool out there to help cover any kind of residual estate tax that an estate might have after doing all the amazing planning that can be done out there. It's like the only tool that can offset that liability dollar for dollar when it's owned in a trust. When that estate tax is due 9 months after passing. The last thing a family usually wants to think about is having to liquidate something to pay a tax. And that doesn't matter if it's a house or business interest or a piece of real estate or even a securities portfolio for that matter, because you just don't know how the beneficiaries are going to react to, do I get rid of this? Do I get rid of that? How's the effect in a very real moment where, their parent just passed away? Like, nobody wants to think about those things. So,
or is it the right timing? Because the market's down and now you need to liquidate your investment portfolio. Yeah. Or the real estate market is not great and now you're going to sell in Texas, we talk about the family ranch all the time, right? Yep. And it's not the right timing, but you're going to sell it at 70% of what you could have gotten from before, Well,
and even basis consideration on that too. Exactly. When something's put into one of these irrevocable trusts, they don't let you have your cake and eat it too, right? Mm-hmm. So you either get it out of your estate or you get the basis adjustment. Mm-hmm. And so, if you have to fire sale that, now you're not only, you're probably selling it for less, but then you're likely facing income on that too. And so,
double whammy.
Yep.
Yeah, exactly. Yeah. The basis step-up is huge, right? Because to your point, if it's inside the estate, then you get it, and you don't have to worry about the income tax ramifications if it's sold right after passing. But yeah, to your point, if it's in trust, you don't get that. So insurance is a great way to help offset that. The other thing that comes up from an estate planning perspective is just like simple estate equalizations. And it sounds like it should be simple. It's never as simple as I want it to make it sound. But I mean, if you've got, particular properties or assets that are earmarked for a particular kid, or a business that's earmarked for a particular kid, but, the other one's a good kid too, and you want to make sure that everybody feels equalized and good about what's happening inside the inheritance, there's little better than a life insurance policy to directly, again, offset, how much one kid is getting for and the other kid is getting. So again, I think that those are probably the main ones. If I'm thinking about estate planning perspectives of life insurance, there's a lot of other uses of life insurance. Obviously, last week we could probably talk for hours about those. But I think those are the ones that really apply whenever we're thinking about estate planning.
My funniest thing in my life is that my mom knows I've been in the life insurance space forever, but she still feels that she's like, but you sell life insurance. Like, how exciting could that possibly be? Like, what does it do? It's just a death benefit. But to your point, Kris, like, we use it for so many different ways of managing risk. And like I said before, it's just liquidity. At the end of the day, it's liquidity. There's also a lot of misconceptions on cost. And so people feel like, well, it's just going to be too expensive, and so I'm just not going to do it. My advice would be at least explore to see if it's an option for you, if you're healthy, or even if you're not. The insurance industry has come such a long way when it comes to underwriting that folks that even have very serious chronic conditions are able to qualify. People that have had cancer. We've had clients with HIV that are still able to get life insurance. So, I mean, things have come a long way, but just thinking about it as liquidity and realistically, in most of the analysis that we looked at, long term, even if a person has a healthy life, they end up paying 30 to 40%, actually more like 20 to 40% of the death benefit in premium. So from a cost efficiency perspective, there's that too. So it's a very flexible financial tool. Sometimes life insurance gets a bad reputation, and I understand because, once again, I said there's some colleagues out there that maybe don't approach it in the best manner. However, it's something just to look at and consider and see, is it something that is going to fit into my planning, that enhances my planning? And I appreciate that you're open to, and that you have that conversation with your clients, because it's also easy. And we do this too. You get stuck in your lane and you're like, life insurance, or maybe it's just, legal documents, but having that holistic approach, which we really do try to take and say, it's not just us that you need a team of advisors that's going to guide you through this whole estate planning process. So,
I mean, one thing I've realized about raising kids is I can't do it on my own. It takes a village. It takes a community to do it. It's a similar thing.
When you said about your wife before, I have a daughter. She's almost 7 going on 14 most days, but whole other conversation. I used to tell my husband, I have a ton of life insurance on myself. I've just got it. I've been in this business for 20 years. I just accumulated life insurance. And I used to say, when I die, if I predecease you, then I want you to go find a really hot wife with this life insurance. I'm like, she better not be ugly, because I'm going to come back and be really upset. But now that I have a child, their priorities have shifted. And I'm like, she's getting none of this. It's like, you better find a good, nice woman. I don't care what she looks like, but she better be good to our daughter. So priorities shift over time too.
They do. They do.
Absolutely. Well, let's talk about something that I think it could be more accurately called, and you've already referenced it, but could be more accurately called will wars at this point, right? So let's talk about probate. Okay. You mentioned it before, but maybe if for our audience that doesn't know exactly what it means, if you can explain, what is probate?
So probate is, I describe it as the court process by which we transfer your assets when you pass away. It typically involves hiring an attorney. It involves going through the court system. And for most people, it's frustrating because the timelines, you're dealing with a court. And depending on where you live, dictates kind of how quickly you can get through the process. And in a time where people are grieving and they're greedy, many family dynamics erupt and blow up at that time, especially if you're the matriarch that was kind of keeping it all together. Probate is usually the quickest way to erupt that family dynamic. And, I will say there's kind of a misconception that Texas probate is easy. Right?
Really?
Yeah.
I don't think anything in Texas is easy. But
thank goodness. Okay. Because I have people tell me that all the time. Like, oh, probate. I've even had probate attorneys tell me that. Probate in Texas is easy. I'm like, well, maybe compared to other states, where they want your blood samples and everything of that nature. But and that's a joke. I don't know if they do. Yeah. But it's better, I would say. But still, you have to go through this. You have to go see a court. If everything's not lined up the way it needs to be lined up. Like, I have a will right now I'm trying to probate where the person spelled their kid's name wrong.
Oh, no.
So now we're having to, and I can't necessarily use that name if they're trying to open an estate account and a bank account under the estate because their driver's license and that name don't match. So you have to jump through all these extra
Were they drunk when they put together the will?
I mean, it did look like one of them legal Zoom, so, Yeah. But again, to me, in my practice, and what I hear is the number one reason why someone wants to do estate planning is they want to avoid probate. And I'll tell you, most of my probate clients I've had in my career become my best estate planning clients because they never want to go through it. They never want their family to go through it. They're just like, this is a mess. I'm paying an attorney significantly more to go through probate than if I were to just pre-plan, get everything structured the way it needs to be set up. Right?
Yeah. Absolutely. Yeah, I have a friend that's a family law attorney, and she said that one time she was in probate for 8 hours over a pair of pearl earrings that it was the wife of one of the children. It wasn't even, one of the actual children that was fighting over why she should get those specific earrings. She pretty much wanted to just die. She's like 8 hours later, they came to the conclusion that she could just have them because they were over it. Like, she wore them down, but...
well, a lot of times it's not the kids. It's their influence from spouses or other friends or things of that nature that get in the way of everything.
Yeah,
especially in that process.
So yeah,
that's run across those families that they're not sure which will is the right will.
Oh.
Or like Aretha Franklin, didn't she write two like on a napkin and they didn't know which one it was?
Yeah, I found this one under the couch.
That's it. That's what I was going to say. The couch will. We get a couch will.
Yeah. Absolutely, yeah. The in-laws and everything else.
And truly, in those kinds of will wars scenarios, you know who wins?
The government.
The attorneys.
The lawyers.
Yeah, that's true. Yeah. So there was a statistic I think that I found when I was preparing for this. It said that Americans spend $2 billion annually on probate, and 50% of that goes to the attorney fees. Mm-hmm. So being mindful of why don't you just prepare your estate and save your family from those 50% fees.
That's right.
Yeah,
that's right. And it is more work to go through probate than it is to get your estate plan in order.
Yeah.
Right? I mean, typical estate plan time frame for me is about 4 to 6 weeks. You have everything you need to now start funding. Mm-hmm. Right? So when probate can last 2, 4, I had one that was 10 plus years.
Wow,
10 plus years.
Oh my goodness. I've never heard of that. That's insane.
You don't want to.
Yeah.
and now there was a family dynamics to deal with. There were just a lot of sleight of hand kind of stuff. So it was really drawn out. And I came in a little bit later in the game to just close it, get it done. Right. But still, it was one that was going on about 10 years. We finished up, I think it was about 11 years when we finished it up.
Wow.
And it's just, think about the money.
Draining emotionally.
It's draining on the family, the money that was spent.
The division, I'm sure it caused.
You talk about the preservation of your assets. The quickest way to
not preserve them.
Is that. So,
if you want your family to just squander your assets, just don't plan for it and have a lot of probate. Yeah, there you go. That's one way to do it. Yep. So I would say we talk about maybe avoiding probate. The answer is do your estate plan.
Well, and not just do your estate plan. That's part of it, right? But do a trust. Mm-hmm. You know, a will go through probate. So you have to set up the revocable family trust. And then again, most importantly, fund the trust.
Yeah.
Deed your real estate into the trust. You know, I have people come in all the time saying, I did this trust online, right? Oh. I'm good. And I'm like, did you do a will too, I hope? Please tell me you did a will, because your house isn't in the trust. Your bank accounts are to your estate. Your life insurance doesn't have a beneficiary. But, you know, again, if all of your assets, let's say you don't own real estate. If all of your assets have beneficiaries named, you avoid probate, right? But if you have real estate, if you have businesses, if you've built a real estate mogul, right? You're going to need to do the next level of planning. Don't leave it to a will-based plan, because a will goes through court.
It's an illiquid asset. Yep. It's not just like dividing cash, right, among people. It's real estate. That's a great point. So are there any other issues you can think of specific to real estate when it comes to probate?
Oh, my goodness, yes. The first one is just because you co-own your house with your wife or husband doesn't mean you automatically get it when they pass away. All right? Because that's a title concern, right? And so to clear title, like if I pass away, my name's still on title. The only way to get title of the house, or my name off title of the house, is to have me sign or to have my power of attorney sign.
Interesting.
Oh, wait, I'm dead. My power of attorney can't act.
I'm dead.
So then it's, either the trustee of the trust, or it's the executor under the will, or there's some other mechanism that has now taken my name off title, right? So that's the conversation I have a lot with married couples is, we need to do something to make sure your name comes off of that easily for your spouse, right? Otherwise, she's going through or he's going through probate in order to now have ownership. If he or she wants to sell and downsize to a smaller place, move closer to the grandkids, now we have issues, And then, additionally onto that, when you're talking about husband and wife couples, right? What if they have kids from prior marriages?
All the time.
All the time. We call them blended families. I'm a product of a blended family. I've got a great bonus mom. And
I do too.
Yeah.
Hopefully, she's kind of my age too, so it's great.
I'll get into that later if you want. But if like my dad and my bonus mom, when my dad passed away, if they didn't do any planning, which they knew a good estate planning attorney, but if they didn't do any planning, his interest would have went to his kids. And so we would have co-owned that house with my stepmom. So when she sold, she'd only get 50%. The other 50% would go to the kids, right? I don't think in a million years that's what my father would have ever wanted to happen. And it didn't, but I don't think they would want the house interest to go to their spouse to then continue living their life, doing whatever they see fit. And so it's important, especially in blended families that own real estate, and even especially, also business interests, to have that estate plan in place, to have those hard conversations of, does everything go to the spouse, or do we give a gift to our kids when we pass away? Does the wife kids get something when she dies?
Mm-hmm.
Maybe from a psychological perspective, yes. So they receive something from their parent at that time, right? How do you balance that based on family dynamics and just the uniqueness of everyone involved?
And just one more question on the real estate front. So what if they own a portfolio of multifamily, properties? And what is, not getting too deep and not too technical, because I feel that'd be a whole other conversation, but what's the right ownership structure there to help protect against a probate issue here as well? Because what if you do have that blended family and they know that you're the patriarch and you died and you had all this portfolio and everybody wants their money now, everybody wants to put their hands on it and get it. So what can they do? How can they structure that better?
So a lot of times it comes down to the layering of the structures too, right? So how do you own the multifamily property or properties, right? Some own them in individual LLCs. Well, then what owns the LLC, right? And then now that's not a real estate interest, it's a personal property interest. So that kind of shifts how things are inherited under the intestacy code, which is the I don't have a will code, right? But even if you were to just simply have a will that spells that out at that time, yes, you still go through probate, but it clearly defines who gets what at that time, right? And so that is where when someone starts moving into business interests or having business LLCs, or a lot of times in real estate, it's like a limited partnership, especially if we're not holding it for a very long time. If we're kind of a buy flip time, then you don't necessarily want an LLC structure. You want an LP structure. But LPs are what's known as a limited partnership. You'll probably talked about them in the last one, but it's a unique structure to give limited partnership interest to one, two, or various number of individuals. We've done it with estate tax planning, so you're giving kids, you set up a trust for your kid and you give them a 2, 3, 5% interest in the limited partnership that owns all of this real estate, all these, your partnership now owns an interest in another limited partnership that gets passive income passing through. So it's all, to me, it's once you get to that point, do you even know your organizational chart?
Right, yeah.
That to me is why I go, show me what you own and then let's talk about it. Because we may need to restructure, we need to may need to move some pieces around, we may need to gift some things away. But again, it's all the pre-planning ahead of time, because especially in those scenarios, that's where most of the money will go to lawyers.
Yep. Yeah.
Right.
More complexity. And I just feel like nowadays all families, regardless of the size of, if it's a real estate portfolio, whatever that wealth is coming from, there's just complexity in general because of blended families and just different dynamics. So the other important thing, and kind of to close up this conversation too, is clients come to us many times and they're like, oh, I did my estate plan in 1982, And so I'm like, that's wonderful. However, since then, you've had children or grandchildren, your estate has grown substantially. You've added real estate, you've added businesses, so much has changed. And back in the day, you were worth 100,000, now you're worth 100 million, right? Something like that. So what do you do with your clients to ensure they're being proactive and mindful about updating their estate plan? And how often do you recommend they updated it?
So I typically, personally, I try to touch base with my clients once a year, right? And just it's a simple email that says, have you had any life-changing event? Births, deaths, divorces, marriages, you've purchased property, sold property, what have you. You've shifted an asset class or you've shifted assets around, right? Because each one of those life-changing events means something different for your structure overall based on what structure you had in place to begin with. But again, most of the time, I'll say, about every 5 to 7 years maybe, I usually say just pull it out, or the names of the individual is still the names you need.
You're still married to that person.
That's an important one too.
Yeah.
But I had one the other day that I was talking to them about it, and they said, I pulled it out this last weekend and realized the person named as the trustee of my trust, I no longer talk to and haven't for like 2 years. Just had a huge falling out due to political discourse, right? And it's like, well, they are in control of your money.
Yeah, that's a problem.
That's a big problem.
Yeah.
And that's why a lot of times, at least for the trustee perspective, I say don't name kids, don't name family, right? Name a corporate trustee. Name some neutral third party. I pay them a fee because they're going to run it the way it needs to be run and do all the heavy lifting. Let the kids be the kids and be the beneficiaries, right? They can take over eventually. But put that burden of the administrative complexity of it, the taxes and the implications of taxes going through with this, put it on someone else. I mean, I've served as trustee one time in my life. Mm-hmm. I will never do it again. I mean, I did it out of the goodness of my heart, but that's no good deed goes unpunished. But it was a life-changing lesson. That's like, clients, unless it's super straightforward and super easy, not a lot of assets to deal with. It's more like just a pass-through kind of deal. You don't want to serve as trustee.
Yeah.
And think about it. I mean, if you're sitting there and your trust has $20 million, $10 million, $15 million in it, and all you're doing is getting a mailbox money,
right?
Why do you want to be in control of it? Just sit back and get your money and go,
And for the children, like, it could be an issue, right? Maybe the eldest, whatever, son or daughter is put as the trustee, and now the other kids may see it like, well, you're just trying to do it for yourself, even though they're trying to do it in the best interest. I've been watching this show on Netflix recently called The Gentleman, and it's not politically correct, I should say. However, the son that they didn't expect to inherit all the money did. He's in charge of it. And I can tell you that the other kids aren't always happy about what he does with it. But he's just trying to be smart, right? Like, he's not doing anything to hurt them. And that could be the same case, too.
It can.
Or the spouses come into play. Yep. Like, why don't you get access to that? Or why aren't you doing that?
Because there's a duty to diversify those assets. I mean, we had someone that we came in later on because they got sued by their beneficiary because they put everything in bonds for the last 10 years. It's like, oh.
Yeah.
And the other piece, too, that is we haven't necessarily brought it up yet, but is with special needs.
Yes.
Adults. It's
so important.
Do you really want their sibling to be in charge of all their money, or do you want them to be their sibling?
Right.
Right?
It's a huge responsibility.
It's a huge responsibility. Yeah. So there's a balance, and you have to find that right balance with people.
Absolutely. So I would say, go ahead, Kris.
Oh, no, I was going to say, I mean, with checking in, I mean, I think about it with myself a lot as well, just as parents age and who we kind of want, when we think about ourselves passing away with kids and guardianship and things like that. Like, if you don't check in and really take a peek at some of those, especially the core documents, you might run into a situation where something, you may not want the kids to go to your parents anymore because it just aged.
Exactly.
It doesn't make any sense anymore, right?
Yeah.
Yeah, absolutely. I would say, so we're in summary, we're all going to die. You should do your estate planning. Yep. You don't want your family to all hate each other after you die. So try to do not just a will, but maybe consider doing some trust planning as well. And also review it and update it, because life happens, things change, new people come into our lives, or, our financial situation changes, and that's kind of an ongoing thing. So it's important to update it. So any other closing remarks, Mark, anything else that you'd like to share just regarding estate planning or what you see from your clients on a daily basis?
One thing that I've come across real recently, I just want to throw it out because we've talked a lot about real estate, is don't put your real estate in an S corporation.
Okay.
All right? Because your family won't receive a step up in basis on that asset. Okay.
Important.
So, I've seen it multiple times over the last year. And so I wanted to make sure during this conversation while you had me today to raise that if you own real estate, do not put it in an LLC that is taxed as an S corporation, because your family will not receive a step up in basis on that. So, but outside of that, no, I mean, I think you hit the nail on the head. You've got to be diligent about getting these things done. You've got to review them. You've got to make sure that everything's properly structured inside of it. And having a great group of advisors to do it is, you've got to have the team.
Yeah, absolutely. Having the team. So true. Well, thank you so much. This has been great. I feel like even I've learned some information about, estate planning and different things. So thank you so much. We really appreciate your time. So if our audience wants to get in touch with you, how can they contact you, or how can they reach out to you for more advice, Mark?
Definitely. I mean, what I think recently it's just search my name online. I think so far I've had enough content out there, but you can find me on LinkedIn. You can find me at, Plunksmith. You can search the website there, but do a lot of content, or try to do content out on LinkedIn and the like. So, and if there's questions, by all means, you can reach out, call me, and email me, and we'll walk through the process. No big deal.
Perfect. Well, we'll make sure to also include Mark's information in the show notes. So we'll have his contact information if anybody wants to reach out to him and keep the conversation going. Make sure you do your estate planning. Thank you so much, Mark. We really appreciate all the insight that you shared. And I know our audience is going to benefit from it too. So thank you.
So in our final segment of every episode, we always go through maybe a planning myth or some unsuccessful strategies and try to dissect them and see if we can find better solutions or the more accurate information. And we lovingly call this section the shiny object whack-a-mole section. And Kris was the one that came up with this name, but it's very accurate for what we discuss. So since we started off the episode talking about succession, I think it's just fitting for us to go back and look at how Logan Roy used his own wealth, what he did from an estate planning perspective, how he prepared his children for their wealth and kind of dissect this very shrewd patriarch that he was. So, Kris, if we go back and we think about the show, Logan, his estate planning strategy seemed to be just putting his children against each other, kind of in a corporate Hunger Games type of setting, right? And that made for great TV. It was a wonderful drama. In real life, that strategy probably doesn't work. And at the end of the show, we saw it really wasn't the best solution for preserving his wealth or his legacy. So kind of instead of throwing your heirs into this ultimate showdown, what do you think would have been a better strategy for him to use to see who was best suited to lead his company?
Oh my gosh, this sounds awful. So they're, sitting there around a table yelling at each other, all vying for the top spot of the company, but not actually knowing what the actual inner workings of how the company actually works. There's so many problems to unpack on something like that because one, you have siblings who are just fighting each other for a position that may or may not really exist, and so they're all vying for this position at the top of the company again without actually knowing what the thing does. So you have discord amongst all of the kids again just fighting for one particular position running the show when in reality the only way to actually understand how to run the show would be to work within the business itself. So what we've seen with a lot of the families that we work with when they're doing this kind of a successful transition, it's usually a period because it doesn't happen overnight. You can't fight for it and have one person holding the sword at the end of the fight and saying, I won. It takes a long time. You got to understand, what the family members are good at, what they enjoy doing within the company and sort of let them grow naturally into their roles, but by giving them, all the experience and expertise you can of having run the operation for such a long time. A lot of kids are going to be very interested in what their family is doing, and there is a natural want to kind of understand how it works, but there has to be a willingness to really get them involved as well, so they can understand how to become a leader, not assume they are a leader.
Yeah, absolutely. So we've seen families do even internal internships, right? So try and see if you are suited for that type of company just because you've grown up around that company or that particular business. It doesn't mean that you are the best suited to run it. There's so many other ways this could have been done to prepare them. We've even seen families that start helping or preparing their children from when they're really small. I had a family that we worked with that as soon as their kids could pretty much 10, 11 years old, could be responsible enough to let them run around an office. They would have them bring coffee to people that make copies. It was just a way of embedding them into the business versus just saying, here, one day, first of all, I'm going to help raise you as a brat, but also see if you can run my business one day. And in the meantime, go to the death at it.
Yeah, no, totally. What makes good leaders in the companies that last multi-generations is that they understand the business from the bottom up. So maybe, they knew how the mailroom works, they know how accounting works. They know what the secretaries and the administrators are doing. They know what salespeople are doing. They know all of it, right? And so without getting involved at that bottom and growing into it, like you said, sort of, grooming them into those roles is going to be a battle at the end.
Well, and they all what was it, 4 of his children, all were uniquely unprepared to take over this empire. They had these brief moments of brilliance when you thought, this person actually knows what they're doing, but those were quickly overshadowed by some kind of cringeworthy attempt to either outshine their sibling or to impress their dad. So one of my favorite scenes is in season 2 where Kendall, he goes up in front of a group of people that are there to honor his father and he does a rap. And it was very bad. Everybody, if you haven't seen it, you should go see it because it's hilarious, but it's also very cringy. So just FYI, just be aware of that. So imagine if instead of this kind of shrewd patriarch, their father, Logan, took more of a mentor type role. what would have been some other strategies that he could have used to prepare his children, not just for the leadership, but for the wealth they would inherit? Like, what have you seen some families? How have they prepared their children?
Yeah, no, that's a really good question, and it's honestly it's a mixed bag. Unfortunately, there's what I guess I hope would happen, and then there's the reality of what does happen, and a lot of it just ends up kind of being in between. But to your point, like, before, and why this is such a big deal, there was a PwC study that was done in 2021, and there's only, it says there's less than 20% of family businesses actually transition to the second generation. And then only about a quarter of family businesses are actually focused on next gen involvement. And so what that tells me is that there's a lot of families that might be thinking about it in their head, oh, my son or my daughter is going to take over the business. But again, they don't bring them in. They just don't incorporate it for a reason. And then it becomes problematic. It becomes problematic down the road.
But one of the things I see so often is where the parents or grandparents will say, well, we're going to leave all this money for them, but we don't want them to know what they're going to get.
Want them out.
And so how can you possibly prepare them for what's to come in the future if at the right opportune time, age appropriate time too, you don't start to share with them, because it's also a lot of responsibility on them. It's not just a benefit. It's not just, this great inheritance they're going to receive. It comes with a lot of responsibility. And that's why, once again, we see this shirt sleeve to shirt sleeve story all the time where, 70% of the wealth is lost by the second generation, 90% by the third generation, which is a terrible statistic, but it's a tale as old as time. It's nothing new. We see this over and over, and it's not just in the United States, it's across the world. I think the key is prepare them as and there's even professionals and we'll definitely have a future session on just this topic, but there's professionals that can help you if you as a parent don't know how to do it. Prepare your children for that wealth that they're going to inherit, because if not, I can almost guarantee you that they're going to squander all your money, not because they want to. It's not going to be like some kind of, they're just going to go drugs and I don't know, inappropriate places, but it's going to come back to them just not being able to know how to manage it, right?
No, completely. And it's also about, it's one part education for sure, because they don't know that something is coming and then all of a sudden it's in their lap. That could be a lot to take on. And similarly, if you know that you're going to inherit, several $1 million, $100 million, whatever it is, and you're an 18-year-old, like that dynamic is going to be completely different than if you're, 25, 26 as well, and then start understanding what that actually means. So to your point, I think that like education and again, just that family involvement is paramount. My family, I don't have $100 million, Celeste, wish I did, I guess. But
we doesn't know that, so you can tell.
No, okay, I'm sorry. With my family, since we're worth $100 million. But we talk about, finances, and we talk about what's important to us as a family nucleus, and philanthropy, and what it means to be a good custodian of wealth, a good custodian of just a good person, right? How do you be a good person out there in the world? And so if you start to include kids into those types of conversations, you're going to have a much better understanding, one, of what sort of the family expectations are. So again, passing down sort of that who we are as a family, and then as time goes on, you can start incorporating more finances and more understanding about how the world actually works, and the wealth that at some point will come down to them. They'll be much better prepared for that. Again, but they have to be educated. They have to know. They've got to have an understanding. It can't just fall on them.
Absolutely. I mean, that applies at all levels of wealth, right? Yeah. In our house, we started doing a couple of different things to try to prepare our daughter, but just kind of, one thing we started doing is matching, so she understands 401k planning. So if we have two little jars she can put money in. One of them is the spend, the other one's the save, and she puts it in save, we match it, So it's these little things you can start to do with kids. Once again, it's not because we have this giant amount of wealth. It's just to help her start understanding what the dynamics of economics are, right, at the end of the day.
Yeah, totally. I like that one too. I'm gonna borrow that one. I think that's a great one to use. You and I have talked about this in the past. Like sometimes my daughters will ask me what I do, and they understand that I do life insurance. They don't necessarily know what it means to do life insurance, but they know that life insurance is an important thing. And so we always talking about like, why is it an important thing? Like, why do I have life insurance? And so I explain it to them and they go, oh, well, that makes a lot of sense, right? And to your point, that's how you say it.
To your point, you explain it to them. You don't shelter them or tell them, I don't want to explain it to you. We'll talk about it later. As our parents, at least my parents, they're like, I don't know, we'll talk about it later. Last thing about, going back to the Succession, to the show Succession, is anytime an outsider tried to come in and take over the business, it seemed that the children actually united and started to work together. But it was always short-lived because their egos or their hunger for this power just blinded them. So sometimes the best leader for the family isn't going to be born into the family. And you've already kind of alluded to some of this. How does someone gauge that tipping point between preserving the family legacy, protecting this business, but also ensuring that there's prosperity in the future? What have you seen other families do in this situation?
Families that have done really well with this have really good advisors around them, honestly. They don't pretend to try to understand it all or know it all and know how to make sure that they're saying the right things to their kids so they, are hearing them the correct way. That, again, to the great conversation we had with Mark around how, the estate planning is going to transition and why it's set up in certain ways. It's just, so I think that part one is just having those good advisors in and around the family and involving the children in some of those discussions with the advisors. I think that it tends to a much better plan, a well thought out plan that everybody kind of gets and understands. And I also think that it gives that acceptance to, you can't know everything, and it's good to have counsel. It's good to have outside advisors bring in those outside ideas and concepts to help make sure that, again, the wealth stays in place and that the family's legacy is intact.
And don't force it, right? Because I feel like sometimes the parents or those patriarchs are saying, well, this is the family business. This is what you need to be in. And many times those children are going to self-select out. And I say jokingly, the artistic child or the child that wants to do something different is absolutely not going to be a good leader if you're forcing them to do something that they don't want to do. So being realistic and knowing that it's not for everybody. Being an entrepreneur is absolutely not for everyone. Some people want to do artistic things or they want to work for a company, they want to be an engineer and just do the things that they love. And so being open and flexible and understanding that it may not always just be a family business, but there's great examples like the Ford family that, has expanded beyond their children. So many other of these super successful families have expanded beyond just family. And they're thriving because they were open-minded to doing it. So, in all of this conversation, it's so clear that the intersection between wealth, legacy, family dynamic, proper planning, there's so much complexity to it. But at the end of the day, it just comes out to addressing it, being realistic, not pretending it's not there. Because if we can plan for it, then we can prepare for it, as they say. And sure, there's a lot of that great TV drama like we saw in Succession. And sometimes we think that's not real life, but it is. A lot of the families that we work with, maybe not to that extreme or not specifically, and sometimes to that extreme, have the same struggles. So it's important to address it eyes wide open so that we can preserve wealth, we can protect legacy so those businesses can continue to thrive. So important is just, once again, planning. Just do it. Don't ignore it. It's super important. Thank you so much, Kris. Really appreciate, as always, your insights. I have the benefit of talking to you every day, so I get your insights every day, but our audience doesn't. So really appreciate what you've shared, and we'll talk again in the next episode.
Awesome. Really appreciate it. Thanks, Celeste.
Thanks for listening. Don't forget to like and subscribe, and please be sure to follow on your favorite podcast player. To connect with us, you can email us at hello@robinglenn.com or schedule some time with us via the link in the show notes. You can also find us on Instagram and TikTok at Hello Robin Glenn.